In this video, we're going to discuss finished goods inventory. So you would see finished goods inventory for a manufacturing company because remember they have three types of inventory. They have raw materials inventory, work in process inventory, which is partially completed units, and then finished goods inventory. So think about a company that builds houses. They start out with raw materials, which would be lumber, for example. And then they convert that to the frame of a house where the house is not fully built, but they've got a frame there. And then at some point they actually finish it and they have a house. Okay, so for that home builder, the house would be finished goods inventory. It's goods that have been manufactured and now they are ready to be sold. They're good to go. A customer can actually go and purchase it, right? So that's a finished good. Okay, so this is one of the types of inventory, and this is the last type before it's going to flow through cost of goods sold and end up on the income statement. So let's take an example. Let's say that your company has builds canoes, and so you just let's pretend they use job order costing. If you don't know what that is, don't worry. We'll talk about it in a future video. But basically, the idea is that there was an order to produce 70 canoes. And so you've tracked the manufacturing costs associated with making those 70 canoes, and it was $35,000. Okay, and I'll have another video about how to put together a job cost sheet and stuff, but this is the main idea for right now. So, $35,000 job, you just finished it. So it was work in process inventory because you were working on it, right? So you had made prior journal entries when you originally bought the wood or whatever, get the canoes, you had debited raw materials inventory. Then at some point you started processing the materials, you added some labor, you got work in process inventory. But now that you're taking the canoes out of, they're no longer being processed because they've been completed, they've been finished. You're going to debit finished goods inventory. So you're going to increase finished goods inventory for $35,000, but then you need to decrease work in process inventory to show that, okay, look, this inventory is no longer being processed. It's now ready for sale. Okay, so you're really just transferring it from one inventory account to another. Now, we've got the inventory in finished goods. Somebody could buy it. Let's say that a customer buys all 70 canoes. Now, what are we going to have for the journal entry? Well, we're going to have to expense this because now all this stuff, if you think about it, so this finished goods inventory, that's an asset, right? But we no longer have that asset because we sold the canoes. Those canoes are gone. So we're going to credit finished goods inventory for $35,000 because we sold all of them. And so now what are we going to debit? We're going to debit cost of goods sold for $35,000. And then the cost of goods sold, this is going to go on the income statement. And it's going to reduce the company's net income, right, which ultimately is going to reduce stockholders' equity as well. And then this credit to finished goods inventory, that's going to reduce the company's total assets.